Hi there. We're going to walk through the steps that you will take to create financial statements. And the first thing we're going to do is we're going to look at all the accounts and the account balances that we are given, and we are going to make some decisions as far as what type of accounts these are. Now, if you've watched the video before, the way that I teach accounts is ALORE. That's assets, things that you own; liabilities, things you owe; O is for owner's equity, and for a corporation, that's stockholders' equity. R is revenue, money that you earn, and E stands for expenses, and those are the cost of doing business. So what we're going to do here is we're going to look at the accounts just right here, and I'm going to make some notes as I go through. So accounts payable, anytime you see the word accounts payable, you'll know that is a liability. Accounts receivable is money that people owe you, and that is an asset. Now the next part says adjustments to reconcile net income to net cash provided by operating activities. And so that is something that's going to go on the cash flow statement. And that's going to be an operating activity. It's going to be in the operating activity section of the cash flow. So that's not an account type. This is just telling us something that we need for the cash flow statement. Cash beginning, well, cash is an asset. Cash ending is what actually we will put on the balance sheet. And then cash receipts, well, that's talking about money that we collected during this month. And so issuing stock, that means we sold some stock, so we received cash. Okay, so I'm just going to put here that is a positive cash flow. And when we issue stock, that is a financing activity. That is a way that we raise money for our business. Sale of land means we got money, so that's going to be also a positive cash flow. Cash flow. And when we sell land, land is a long-term asset, and long-term assets are investing activities. Common stock is an equity account. So far what we have is accounts payable, and I'm just going to kind of gray these out. Accounts payable is an account. Accounts receivable is an account. And then your asset, cash, is one of your accounts that you're going to use to build your financial statements. And then common stock is an account. Land is also an account, and land is an asset. It's something we own. Payments of cash, this is going to be another cash flow item. And payments of cash, we're just going to say it's a negative cash flow because we pay the cash to acquire land. We bought some land, so our money came out of our pocket. It's a negative cash flow, and land is a long-term asset, so this will go under investing activities. Dividends, well, when you pay dividends, money comes out of your pocket, so it's a negative cash flow. And that is a financing activity because dividends are associated with stock. Dividends are payouts to our stockholders. And the reason we have stock is to finance our company, to raise money, right? So financing activities is the activity that it will go under in the cash flow statement. Rent expense is another account, and rent expense is an expense. Retained earnings is an equity account. And I'm going to gray this one out because we're going to need that for our financial statements here. Salary expense is an expense account. Service revenue. Now this is a very important one because this is a revenue account. Now, revenue accounts represent money that we have earned. If we issue stock to stockholders, that is not money that we earn. That is when people have invested in our business. So what we end up paying taxes on, well, that's money that we earn, that revenue, less all the expenses for our business. So service revenue, this could be sales revenue, this could be fees earned, it could be called different things, but a revenue account is when you earn money. Now supplies, let's talk about supplies for just a minute, because when you purchase supplies, you put them in a supply closet, and that means you own the supplies and they're a resource that will help you make money in the future. So a supplies account is an asset account. Utilities expense, once again, that's another expense account. And most of the time, expense accounts will have the word expense in them. Not all the time, but most of the time. Okay, so what we've done is we have labeled the different accounts here is assets, liabilities, owner's equity accounts, revenue, and expenses. So what you have left are things that will go on the statement of cash flows, and we'll get to that in just a minute. So the first thing we're going to do is we are going to create an income statement. Well, you need to know the formula for an income statement, and the formula for the income statement is always the same, and the formula is revenues minus expenses equal net income. Now, if your expenses are more than your revenues, that would be a net loss. You will never see assets or liabilities or equity accounts on the income statement. It's very important that you know what goes on the income statement. So let's look up here and find all of our revenues. We only have one revenue account, and that was called service revenue, and service revenue was $10,000. Expenses. Now what you'll do is you'll list out your expenses, and those will be from greatest to smallest. And if you have miscellaneous, miscellaneous will always go last. And so what we have here is salary expense, for $1,200. And where's our other expense? Let's see. Rent expense, $1,100 or $1,100, and utilities expense, $400. And then you will total your expenses. And I'll put a little line there under that to total expenses. And then we'll see net income down here. Now our formula for net income is revenue minus our total expenses, and that's $7,300. So that is the answer to our income statement. Now one other thing I didn't talk about with this income statement is that an income statement is for the month ended, and you would date the month, whatever that is, okay? And so if it's for the year ended, you would put that here, but it is for a period of time because you have earned the money and you have incurred the expenses over time. The next statement we will build is the statement of retained earnings. Now what I want you to see here is the statement of retained earnings is basically reflects the beginning retained earnings plus net income minus dividends is going to give you ending retained earnings. Now what is retained earnings? Well, it's the portion of equity that is kept by the company or owned by the company. So you have stockholders, and their ownership is actually represented by this common stock account. And then we have retained earnings, and you think about retained, that is the part of net income that the company is going to keep so that they can continue their operations for the next year. And there's a certain amount of retained earnings that a company must keep. If you think about Nike, they need to retain some of their earnings so they can pay for the equipment that they need and the materials they need to make shoes and clothing for the next year. Okay, so same concept here. Statement of retained earnings. It's going to be beginning retained earnings plus net income minus dividends equals retained earnings ending balance. Okay, so here beginning retained earnings was given to us, and this is a brand new company, and so beginning retained earnings is 0. Then net income is not given to us, but we had to calculate net income here when we created the income statement. That's why the income statement is always created first. So 7,300 is net income. Dividends paid is given to us 2,100. So ending retained earnings equals beginning plus net income minus dividends gives us ending retained earnings of $5,200. The next statement we will complete is the balance sheet. Now, one thing that is different about the balance sheet is it is created on one day. So the date here will always be the last day of the month or the year. And I'm just going to put last day of the accounting period. The reason for that is because the first thing you're going to do is you're going to list out your assets. Well, you can't tell how much cash you had all year long in one number because that number depends on what time of day it was and when a deposit was made or when a check cleared the bank. And so what you have to do is the last day of the accounting period, at the last hour or whenever you calculate this, that's when you're going to take a snapshot of all the assets that you own, and you're going to put their value here, or their book value here on the balance sheet. So the first asset we have is cash, and unfortunately in this particular problem they did not give us the balance for cash, so I'm going to leave that blank right now, and I'll even gray it out so we'll know that we need to solve for cash later. All right, and I'm going to make this, I'm going to make this a little wider here so that we have a little space there. Okay, so here we are with our balance sheet over here. All right, so we have cash, and cash is always listed first on a balance sheet because it is the most liquid asset. What is a liquid asset? Well, liquid assets are easily converted into cash. The next asset we list is always accounts receivable. Why? Because if we needed cash, we could collect that pretty quickly. And so the balance of accounts receivable is $2,000. Let's look on here to find our other assets. And we have supplies, $3,700. Now I want you to see that these three assets are current assets. That means they will be used up within 1 year. Next we have land, and land is a long-lasting asset or a long-term asset because it's going to last us more than 1 year, and the value of the land is $18,000. Somewhere down here we're going to total the assets. Remember, we're missing a number here, so we're going to come back and solve that. Oh, and you know what I forgot to tell you is the formula for the balance sheet is the accounting equation. It's assets equal liabilities plus stockholders' equity. So now let's look at the other side of the balance sheet. Let's list out our liabilities. Accounts payable is our liability here. So accounts payable is $1,800. Total liabilities are $1,800. There's only one liability, so we would total that up, Then we're going to fill out the stockholders' equity section of the balance sheet. So the first component of stockholders' equity is actually called paid in capital, and that is represented by common stock. And that's how much money the stockholders have paid into your company. And for this company, common stock has a balance of $50,000. Then the next component of stockholders' equity is retained earnings. Well, we know the ending balance of retained earnings. Remember, the balance sheet is always the last day of the accounting period, so we would use the ending retained earnings balance of $5,200, and that would give us total stockholders' equity. And I normally just abbreviate stockholders' equity as SHE of $55,200. Then at the very bottom of the balance sheet, we will put total liabilities plus stockholders' equity here to get our totals. Now I'm going to add my lines here in Excel. And so here's my formula for total equals total liabilities plus total stockholders' equity is $57,000. And I'm going to add the zeros to this by clicking here and taking away the two decimal places. So now I can plug in cash. Well, total assets is $57,000. And so we know that land is $18,000, supplies are $3,700, and accounts receivable $2,000. That means that our ending cash must be $33,300. In accounting, we just call that a plug, and that's when you've actually filled in the blank or you found the missing piece of the puzzle. Now we're going to look at a very abbreviated statement of cash flows. So let me move over here. Statement of cash flows. The first thing we are going to create is the cash flows from operating activities. Now, the other section is called cash flows from investing activities, and then you have cash flows from financing activities. And the answer to the cash flow statement is always given to you, which is why I really like the cash flow statement, because we know the answer before we ever start. So we start from the bottom up to create the cash flow statement. So let's fill in a couple of blanks. The ending cash balance. Well, we know that because that's what's on the balance sheet. So $33,300 is ending cash balance. We started out with 0, and that means that during this month or during this year, we had an increase in cash of $33,300. This is the answer to the cash flow statement. Now let's look at the statement of cash flows. The statement of cash flows has 3 sections: cash flows from operating activities. These are the day-to-day operations of your business. Cash flows from investing activities. These are your long-term assets. And cash flows from financing activities. These are your equity transactions and your long-term liability transactions. So the first thing we'll do is we'll start off with net income. Well, when we created the income statement, we figured out that net income was $7,300. So $7,300 is here. Adjustments to reconcile net income, that was given to us in the problem information. The adjustments are negative $3,900. What we'll do then is we'll subtract that out. So I'm going to make my subtotal here, and we'll say net income minus $3,900 is $3,400 net cash provided by operating activities. So there's a positive number. So that explains part of this positive increase in cash, but not all of it. So now we're going to look at cash flows from investing activities. Investing activities always have to do with long-term assets. You'll need to memorize that. So we acquired some land. Well, when we acquire land, that means we purchased land and we paid $40,000. So right here, we paid $40,000. So I'm going to type in negative 40,000 because it's a cash outflow. And then here we sold some land. Well, when you sell land, you get cash. So it says cash receipts. We sold land and we got $22,000 for that land. So 22,000, and that's a positive number because we received that. So what we're going to do now is we're going to net that out, and the word net in accounting just means the difference between two numbers. So net cash flow used for investing activities, which is long-term assets, is an outflow of 40,000 and an inflow of 22,000 gives us a net outflow of 18,000. Net cash used for is the terminology when there's a negative number. Now let's look at cash flows from financing activities. Financing activities have to do with long-term debt, so that's long-term liabilities, or equity accounts. So the sale of stock. Well, the reason that corporations issue or sell stock is to raise money. So here, cash receipts, we issued stock and we received cash of $50,000. So that's a positive number here, 50,000. And then we paid dividends. Dividends are also part of financing activities because it has to do with paying out a payment to our stockholders. So it has to do with equity. And so dividends paid are $2,100, and that is an outflow of cash. It came out of our pocket. So I'm going to make that a negative number. And then we will calculate the net of those two numbers, which is the difference between those two numbers. So we'll say a positive inflow of $50 plus an outflow of $2,100 is $47,900. Now we need to check our answer. Remember, this is our answer, okay? So I'm going to come over here and check my answer. I'm going to say 3,400 minus 18,000 plus 47,900 is 33,300. So yes, this cash flow statement is correct. So I hope this gives you a better understanding of how to evaluate these accounts, how to pick out which accounts are what, and then how to create the financial statements.